Good evening. Good evening, everybody. Bienvenue à tous et merci d'être avec nous ce soir. My name is Isabelle Bajeux and I'm the Dean of the Desautels Faculty of Management here at McGill University. I'm delighted to welcome you to this year's edition of the Laurent Picard Distinguished Lecture Series entitled A Financial Approach to Climate Risk. I want to wish a very warm welcome to Principal Suzanne Fortier, our esteemed alumni, Desautels Advisory Board members, McGill colleagues, and students. And of course, to our man of the hour, Dr. Robert Engle, professor at NYU Stern School of Business, and 2003 Nobel Laureate. The annual Laurent Picard Distinguished Lecture Series, which is named in honor of our former dean, features outstanding researchers who are nominated by our faculty members. This year, we are privileged to welcome such a prominent and respected researcher to McGill. With environmental issues of major concern worldwide, Professor Engle will enlighten us on a topic that is immensely relevant. I'm now delighted to invite Principal Suzanne Fortier to introduce our speaker.
Merci Isabelle, bonjour à vous tous et merci d'être avec nous ce soir pour accueillir le professeur Engle. C'est vraiment un privilège pour nous de l'avoir ici à McGill, alors merci d'y participer. The topic of Professor Engle's lecture, A Financial Approach to Climate Risk, is of course of enormous importance for the future of our planet. It is a topic that has seized the whole world community and of course the McGill community as well. And I think we're all seized with the urgency to take concrete actions with regard to sustainability. Donc c'est vraiment un moment très opportun pour recevoir le professeur Engle, en fait qu'il puisse partager avec nous comment le secteur privé peut contribuer à la solution de ce problème très important. As already mentioned by the Dean, Professor Engle was awarded the 2003 Nobel Prize in Economics, and this was for his research work, and the prize he shared with Clive W.J. Granger. Professor Engle is the Michael Armeniolino Professor of Finance at NYU, New York University, Stern School of Business. He's also the director of the Volatility Institute at the Stern School at NYU and co-founding president of the Society for Financial Econometrics House at that university. Before joining NYU, the Stern School in 2000, he was Chancellor's Associate Professor and Economic Department Chair at the University of California, San Diego, and Associate Professor of Economics at MIT. He's a member of the National Academy of Science. Please welcome Professor Engle. Merci et bonne conférence à vous tous.
Well, thank you so much, Principal Forestier and Dean Bajeux. I wish I could respond in French. It's such a beautiful language, but you're going to have to deal with me in English today. It's a great pleasure to be here. I've had friends teach here for many years and in several departments, but I don't think I've given a talk here, so it's great to do this today. And I'm going to talk about a financial approach to climate risk, which is actually the name of a course that I'm now teaching at NYU. It's a 6-week course, which ought to fit into an hour. More or less. So I'm going to give you kind of the picture that I see of this field, and I'm going to give you sort of toward the end our current research position on this, which actually has come up in lunch conversation today and actually in this afternoon. So I think it's relevant for some of the debate that you're having here about the management of the endowment portfolio. So well, let's just I know what I wanted. One tiny thing to say. Yesterday, we launched the new Volatility and Risk Institute at NYU. Now, you might not actually notice that it's changed its name. It's now got risk in the title instead of just volatility. I kind of always thought volatility was enough, but there are a lot of interest in other kinds of risk, and one of the kinds of risk that people are interested in is climate risk. So the launch of the new Volatility and Risk Institute is a good reason for talking about climate risk today, because it's a kind of a risk which doesn't really look like financial volatility. It looks like a different kind of risk, but it's got its own features which are going to be important in what we talk about today. So I want to start at the beginning. What's the assessment we have from the scientific community? Well, scientists say the climate is changing, but they're not really very good at saying how bad it will be, and in particular, what are the impacts on my children and their children? What will the governments of the world do? The scientists have very little to say about that. And what new technologies might become available? They have some things to say about that, but they're not that optimistic. So clearly, if we want to talk about long-term scenarios for the global economy, there's a whole lot of uncertainty in what we can say about these. And so it is natural to think about this as a problem, not just of what is the right thing to do, but how do we manage the risk of climate change? Thinking of it as a risk rather than as something we know is going to happen changes the way we manage it. So what's the scientific evidence on this? I don't know whether you've all experienced some friends who turn out to be climate skeptics or other people who are climate skeptics, but basically, let's look at the data for a moment. Is the Earth warming? Well, we talk about the temperature, we talk about 2 degrees centigrade and so forth, but what does that really mean? How do you measure the temperature of the planet? I mean, you've got daytime and nighttime, you've got seasons, you've got hemispheres. There are a lot of different places to measure this, and these are all complexities in this measurement. But basically, what the science does is try to measure an average temperature over the seasons and over the geographical region of the surface. But there are a lot of ways to do that. And if you look at some of the plots, here you see a picture of what these temperature estimates look like, starting in actually the 1850, I guess, and 0 on this is a sort of a historical measure that we're going to basically use, which is something like 1950 to 1970, some area like that. And on this picture, you'll see that there are actually 3 curves. There's a brown, a blue, and a black curve. So these are different groups that have measured this. They measure it different ways. And it looks like there's a lot of noise in this picture. The temperature is jumping around up and down and so forth. But interestingly, all 3 of these curves pretty much move together, suggesting that it isn't really measurement error so much as it is that the climate is fluctuating over time, but has a pretty pronounced trend, especially since the maybe 1970 or so. It's been increasing quite steadily. But that's not the only way to measure temperature either. Another way is to measure the temperature of the oceans. And if you look at the temperature of the ocean, you'll see that follows a very similar pattern. Another thing to look at is the sea level, because if we have glaciers and ice that are on land and are melting, then they contribute to the level of the ocean. And of course, as it gets warmer, it expands a little bit, and so that also leads to sea level rise. So that if you look at the sea level, you see it's also rising much in the same way. So is this man-made, or is this just natural? We should think about how the Earth is heated is radiation from the sun, and this has, of course, been continuing forever. However, the sun is not constant, partly because the Earth has got an orbit that's eccentric a little bit, and also because the sun has fluctuations. So the bottom line is a graph of the radiation that hits the Earth from the sun. So that's the input to heating the Earth. That turns into temperature, and the more radiation that comes from the sun, you might expect the warmer the temperature. However, if you look at the bottom curve, you see it's sort of a cyclical and is not really moving, whereas the top one is the same temperature picture I showed you before, has a definite trend in it. So that it's not possible to explain the temperature variations of the Earth by this change in the solar energy that's hitting the Earth. So what's the missing feature? The missing feature are greenhouse gases. And this is what science has turned to try to understand why we can have a trend in temperature when there's no trend in the solar energy hitting the sun. The greenhouse gases are quite a few different kinds of gases. The most important is CO2, but also we have methane and nitrous oxide and some others. What these gases do is they absorb infrared radiation that's re-radiated from the Earth. So when this solar energy hits the Earth, it warms it up, gets warm during the day, and then, especially at night, but actually all the time, when the Earth is warm, it radiates lower frequency infrared radiation back into space. And that is actually one of the most important ways the temperature is managed in a planet. Otherwise, it would just get hotter and hotter and hotter. So if it re-radiates this out into space, that cools it. But greenhouse gases absorb a lot of that radiation and keep it from going out into space. So what do we, is this a good or a bad thing? Well, actually, it's a very good thing because it means it doesn't get so cold at night. At night, it would go down to, many, many degrees below zero every night if we just had the heat radiating out into space. That's what happens to planets like Mars that have no atmosphere, or basically no atmosphere. It moderates the seasons to some extent, and it makes the planet has a much more stable temperature setting. But of course, if it's too good at this, then the energy stays on the Earth, and it gets hotter and hotter. And as an example, Venus is a planet which has a very heavy atmosphere, and it's full of CO2, and it's a greenhouse gas which gets not very much of the radiation is emitted, and Venus is a very hot planet. Mars is a very cold planet. We're in between, and we want to stay in between. And so that means we want some greenhouse gases, but not too many. Now, it turns out that the greenhouse gases are in a very narrow band around the Earth, shown in this picture, but they play this really important role. Over time, we can look at the concentration of CO2 as it's measured in a lot of different ways. And this is a kind of a cool picture. It's actually a movie, and I'm about to show you this movie. So here's a map of the world. This red dot is Mauna Loa in Hawaii, which is one of the stations in which CO2 is monitored. And the blue dot is the South Pole, Antarctica, another place where it's monitored. There are also quite a few other dots on here where it's monitored as well. And if you look down here, you see here is the blue dot is 90 degrees south, and it's like 335 parts per million, something like that. The red dot's a little bit higher, and here are some other places where it's measured. Here's a clock. We're talking about 1979, January. And when I hit the go button, this is going to start marching through time. And you'll see these measurements changing. And over time, there are more and more places that measure this, and we're going to see an interesting picture. So the clock is turning up here. We're getting more measurement spots in the map, and the concentration is rising. It's now a little higher at the South Pole, but it's even higher at, well, depending on the time of year, in Hawaii. And this is all, those two curves are plotted on this graph on the right-hand side, and you can see this starts in, as I said, 1980, and is rising up through 1995, and it's still going up. In the northern hemisphere, it jerks around a lot. There's a lot of noise in the data in the northern hemisphere, not so much in the southern hemisphere. But the trend is pretty inexorable. You see the seasonality in the red dot, which is between summer and winter. So now we're at 2000. Or no, I guess we're in 2010 now, and we've now hit 400 parts per million. But it turns out you can go back in time too. You can look at other sources, such as ice cores. And this is now going back to 1960. And now we're going back to 1200, 1800. Birth of Christ at 0. So this is the picture we see starting at 0. But let's go back even further. 10,000, 20,000, 30,000, 60,000, 100,000 years, 200,000. So this picture ends at 800,000 years before birth of Christ. And what you see is there have been a lot of fluctuations in the CO2 level in this global measurement. Many of these are actually done in Antarctica, where they've done ice cores that really are very old at the bottom. And so you can see their cycles. But you might notice that they never get above 300 parts per million over the last almost a million years. So what we're seeing today at 400 parts per million is really unprecedented over the last million years, which is quite a worrisome feature of this picture. You can see measurements of all different kinds are kind of supporting the idea that we're in new territory today and that this is something we really have to worry about. And here, if you look at this same scale, 800,000 years ago to more or less the present, CO2 is at the top and temperature is at the bottom. And you see that when CO2 is high, temperature is high. When CO2 is low, temperature is low. These things are moving together. And what the scientists say is that at least in this period, a lot of what made the temperature change was the amount of solar radiation coming in, because it was the distance of the Earth from the sun and things about the orbit. And these are the ice ages that we have seen and we know about, when glaciers grew and then they shrunk again. But now we're in a situation where the CO2 has just gotten out of line with the temperature. It's gotten much higher than the temperature, and so the concern is that this level of CO2, or especially higher levels above, are going to bring the temperature rising much faster. And this rate of increase is much greater than any of these other cycles that we've seen, and so it's very natural to think that this is a different mechanism from what we've seen from natural science. So that's kind of the starting point. And this is data. People can disagree maybe about the theory, but the data they have to explain. And I mean, I didn't show you too much data, but I showed you enough that it takes a pretty sophisticated theory to explain all this data without depending on anthropogenic things, that is, what we're doing to the environment ourselves. So now, what do economists say when they see all this stuff? Well, economists say this is just an externality. An externality is where the emission of greenhouse gases is free to all of us, to all companies, to all individuals, but it imposes costs on others. And the costs of others are the costs of climate change. And those are maybe hard to measure. They may be in the distant future, but they're definitely costs. So this is what we call an externality. And economists have regular solutions to what you should do about an externality. And the main two solutions are either you should put a price on this externality so people actually have to pay for their emissions, or try to regulate them so that you make it illegal to make emissions or more than a certain amount, or make a car that's not fuel efficient or something like that. And if you are able to put on an appropriate price of carbon, the same economists, and I pretty much agree with this, believe that the free market will actually optimally adjust to give the best mix of goods and services, taking into account the damages from climate change. In other words, we don't actually have to do that much. All we have to do is put a correct or close to correct price on carbon, and then let the forces of perfect competition adjust what we do. So there are a lot of changes that would happen, but a lot of those changes are happening already. We're seeing lots of renewable energy built because actually now it's cheaper even at market prices. But it would be much cheaper if we actually had a price on carbon. And therefore, utilities would be foolish if they didn't invest in renewables. And in the same sort of way, we're seeing the interest in electric cars. We're seeing a lot of things are changing in our economy, but they're changing kind of slowly, and they would change a lot faster if we had rationalized the cost of emissions. We also have seen lots of regulations, and people have internal resistance to anything that's got the word tax in it, but they also have resistance to things that have the word regulation in it, and for good reasons in both cases. So what do we mean by regulation? Well, we mean restrictions on what we can actually do in business and in consumption and so forth. What are some examples? Well, the U.S. has now said that you can't produce any more incandescent light bulbs. They all have to be LEDs. And I think that's turned out to be pretty effective, because LED light bulbs were really quite expensive, but extremely efficient and long-lived. But since we've had this regulation, the prices have come down dramatically, and I think that the energy saving has been terrific. Our CAFE standards are what we use for requiring fuel efficiency in cars, and we've actually done pretty well in California, where the standards are higher than the rest of the country, but they've been actually reduced now by the Trump administration, and there is a question as to whether people are being hurt by these regulations because they're being forced to buy cars that are more expensive because they've got fuel efficiency. They're also being hurt because they're being forced to buy cars that are small and lightweight instead of big and heavy. And biofuels are, I think, an example of a regulation that most people think was a mistake, that biofuels are not so environmentally friendly as was thought when they were put in, and they've made the price of corn go up dramatically, and I mean, there are a lot of complaints. So in any case, regulations can be either good or bad, depending on how cleverly they're done. Not a shock. So how are you supposed to figure this out? Well, the idea is that you're supposed to figure it out based on the social cost of carbon. But what is the social cost of carbon? So it's the present discounted value of the welfare damages resulting from additional ton of CO2 emissions today. So if we produce an extra ton of carbon into the atmosphere, it spreads over the whole planet, and it increases the temperature by some infinitesimal amount over the next 50 or 100 years. We measure the additional damages due to this higher temperature, and then we discount them back to the present. And we're supposed to get a number. Well, if you've done much work on macro models, you know that they don't predict 50 years in the future. They're not actually that good at more than a year, probably, or maybe not even that good at a year. And Eric's smiling because he's trying to figure out whether they can predict where we are now. So the idea of a model that can predict 50 years in the future is pretty tough. We need to assume a baseline. We need to assume a damage function, some kind of way of measuring damages. We need a discount rate to tell us how to compare the future and the present. And if we do that, we can get this number. And once we have this number, we can figure out what the optimal tax ought to be. And that's going to tell us, among other things, if we put a tax on carbon, what it should be. But if we want to do regulation, it gives us a way of doing cost-benefit analysis of these regulations. So how do you do this calculation? Well, there are a series of models called integrated assessment models, which are designed to do this problem. And these are combinations of climate science models, which have all physics and fluid dynamics and so forth pieces, kind of like what I was sketching out at the beginning, and economic models. Some of them have a great deal of regional articulation and, for example, altitude articulation, through different levels of the stratosphere and ionosphere and so forth. Others treat the whole global economy as one thing. And maybe not surprisingly, you can get a lot of different answers from doing this exercise. Nordhaus gets $25 a ton from this. Obama administration used $45 a ton. The Trump administration has used as little as $1 a ton. Pindyck, in a review article of these things in the Journal of Economic Literature, is very critical, saying things more precisely than I did, but basically saying, the confidence intervals around these things are enormous. But it's interesting when you finish his article, and he says, you really can't trust these models. Okay, then what's the right answer? What do we do? Does that mean that the right answer is to do nothing? Not necessarily. If we don't know what the right thing to do is, maybe we ought to do halfway between 0 and some extreme thing, or, where should it be? So anyway, he sort of ruminates a little bit about this question, and his conclusion is we need more research, but let's use our best estimates we have today, but work on trying to make them better. And there is some working group that's doing this, and he says, well, they've come up with $33. This is where I'd start. Anyway, I think the point is pretty important, because just because you don't know what's the right price doesn't mean that 0 is the best thing to do. Okay, I want to tell you about a simple model that we can all understand, and it's pretty easy to criticize, but it's interesting to see what does it come up with. And this is an article that was in Nature, Nature Climate Change, by Ricky and some co-authors in 2018. And I guess I've talked about Pindyck already. And what they observe is that when you look at the world, you see some rich countries and some poor countries. You see countries that are growing fast and countries that are growing slowly. And it turns out that the most productive, the highest income per capita, and the fastest growth rates are typically in the temperate zones, especially the northern hemisphere, but also in the southern hemisphere. When it's too hot, they don't grow as fast. When it's too cold, they don't grow as fast. Well, if you think of this as a structural model, that this is sort of a summary of the whole economic system in a way that economists never thought of it, but if you think of it that way, then climate change has obvious implications. Some of the temperate countries will become tropical, and their growth rates will slow down. They'll have to deal with all the things that the tropical places do, like, and mosquitoes and malaria and stuff like that, And some of the coldest places will become temperate and become more efficient. So that says that there are winners and losers in countries. And what does that look like? So here's a picture that she comes up with. So this is the social cost of carbon for each country. And the blue are the countries which have a negative social cost of carbon, and that includes Russia and Canada. Maybe this explains why Russia worried about our election. It's got some intermediate zone countries, temperate zones, which include the US and China and so forth, where the social cost of carbon is quite high, and others where it's even higher, like India and I think Pakistan and some of Southeast Asia. So what we mean by the social cost of carbon is you add up the costs that each country are imposed on each country, and you get a global or a social cost of carbon. So the sum of all these numbers is what 1 ton of carbon would do to the whole world. And even though there are winners and losers, we can add them all together, and we get a number, and that number is $400. So if it's really $400 a ton rather than $25 a ton, we would be putting a much higher price on carbon. We would expect to see gasoline to be more expensive than it is. Using U.S. measures, $25 a ton social cost of carbon translates to 25 cents a gallon of a tax. It's 1/100th of the cost of carbon. 25 cents, it changes by, cost of gasoline changes by 25 cents every month. That's not a very big number. It's hard to imagine that's going to really transform our economy. $400, on the other hand, would translate to $4 a gallon, which is probably about the highest price that in the U.S. we've had for a long time, and it would be twice that high, which, I don't know, is kind of like what it is in Europe. So it's not so unreasonable as a number, I think. So I think we should be thinking about pretty high prices of carbon for making this adjustment. So economists would therefore recommend a global price for carbon emissions at a substantial level. It would raise a lot of money, and this money could be used to reduce some other kinds of taxes. At $400 a ton, the U.S. could completely stop collecting Social Security taxes. Pretty amazing. Think about that. You know, if you say it like that, maybe people would be really more interested in having a tax on carbon. It would encourage rapid shifts of resources to lower carbon technologies. It would incentivize research and development. There are winners and losers, but from a social point of view, the winners should be able to compensate the losers. We're not very good at that politically, but there should be enough there to do that. What's the government response? Well, at least in the U.S., many governments are unwilling to take these steps. Near-term problems trump long-term problems. But it's not really just the government. The electorate is not clearly behind carbon pricing, and the Paris Accord doesn't really get to enforce anything. So it seems to me the consequences of climate change are going to come upon us unless we're rescued by the private sector or by some miraculous technological advance, which we don't know what to make of. So I want to, well, oh yes, so why is this so controversial? Well, some people think it will be ineffective. People will not change their behavior because of a tax. It will do little to reduce carbon emissions and will just bring higher taxes. We've all heard that point of view. A second point of view that I think we've also heard is this will be a disaster because it'll kill growth, make energy too expensive, hurt exports, and paralyze the economy. But you probably haven't thought about the fact that these 2 points are diametrically opposed. One says nothing will change, and the other one says too much will change. So I think we can't believe both of these, and it's the most natural thing is that it's somewhere in between. There would be some changes. There would be some of them we would be unhappy about, but really, I think that the market is pretty good at making these kinds of decisions if we can give it the right messages. So what can investors and companies do? And endowments, maybe. I'm going to talk about, actually, how am I doing? I forgot. Where did I start? Okay, good. So we can do something like what we might call sustainable investing. And this has become very popular. It's usually based on 3 criteria. E is for environmental, including climate, but not exclusively climate. S is for social, and G is for governance. So companies are rated by their ESG scores, and ESG are measured differently by different vendors and different funds and so forth. And we can think that what we want to do is get a portfolio which is more sustainable, that is, has higher ESG scores. But there's sort of a question about, are you sure that's what you want? Or you wouldn't want that if you didn't think the E and the S and the G were well measured. And would you want it if you thought you were going to have to, it was going to cost you a lot? And what is really the objective behind sustainable investing? So we'll talk a little bit about that. The second topic is we might try to hedge climate risk. And what this means is we don't know how bad the climate's going to be. So maybe what we want to have is a portfolio which will do especially well if the climate turns out to be especially bad. So that in the worst case for the climate, we make a lot of money on our portfolio. And in the best case for the climate, our portfolio underperforms. So this would be good for us because it would make our consumption smoother. And really, if everybody did this, it would make the consumption of everybody smoother, and it would be investing in companies that are well positioned to withstand and maybe be unaffected by the climate change, and we would disinvest or short the companies which were going to be most hurt by climate change. So we're going to talk about that. It's kind of like an insurance plan. If you wanted to buy insurance against climate change, you'd want something like this. And insurance policies cost us something, and they only pay off if bad things happen, but that's why we buy insurance, because we want it to pay off when bad things happen. Okay, so can the stock market deliver these things? What do we expect of the stock market? Well, we can talk about climate change as affecting a lot of things. It's going to affect the profitability of many companies, but there are probably things that these companies can do to reduce the impact, and we call that adaptation. And that's actually one of the costs of climate change, is the cost of adaptation. But companies who adapt effectively and inexpensively will actually outperform the market in general. They will use probably less energy and have higher profits when climate change happens. And the stock market should reward these companies. In particular, this would be energy efficiency, which they might do. They might just use less energy, and that would be a good thing. But there's no reason why the stock market should reward companies that are carbon efficient. Why is that? Well, because if you've emitted greenhouse gases for free up until now, and then you do some investment project to reduce those emissions, you're getting costs but no benefits. And so your profit and loss is going to look worse, and your investors are going to say, what are you doing to us? And you're going to say, well, I'm greening up the economy, but we want to ask, why would they do this? Okay, So why might firms invest in carbon efficiency, even though I just told you that it's going to hurt their profits? Well, maybe because it will pay off if a carbon price is eventually implemented or emissions are regulated. So if you think there's a possibility that there's going to be a carbon tax, maybe you want to get ahead of this. And this is reasonable. Maybe because they will be subject to lawsuits for knowingly destroying the planet. We've seen some of these lawsuits. They haven't been settled yet. But it's possible that this kind of legal force will make companies move to a greener and a more carbon efficient way of doing business. Maybe because their competitors are doing this too. So you'll see industry groups that band together and decide they're all going to do some improvements so that they're not really faced with the competition of having to deliver goods which are more expensive than their competitors or profits which are lower than their competitors. But probably the main reason firms might do this is because it's the right thing to do, and they will try to convince shareholders and customers and competitors that this is okay and that they should go ahead and support them anyway. And so a lot of the emphasis on sustainable investing is kind of because it's the right thing to do. And it's part of your, you might accept underperformance of your portfolio, or you might pay too much for your goods, or you might do something else because you think that this is actually the right thing. But how much does it take? That's okay. Another reason you might do it is because it's getting more and more apparent how much emissions are out there. This is a little announcement that we saw some months ago. There's a company called WattTime that got a big grant from Google to measure air pollution from every large power plant in the world with satellite sensors and analyze carbon emissions and post it on the internet. So it may become public information how much greenhouse gases are being emitted by utilities. And if you can do it for utilities, you could do it for other stationary sources. Maybe there will be enough social pressure from that. So one other thing that I should say about sustainable investing is if you have a high E, S, or G score, typically you've done some investment to do that. You're paying your women workers more, or you've hired a better consultant, or you've invested in green technology or something, and so you might have higher costs than your competitors, but it might be that this is a smart decision to make because it gives you better profits in the long run. And so the word sustainable suggests that investors should be willing to invest for the long run if they think they're sustainable investors. And this is in contrast to a lot of views of what the stock market does, which is it looks for short-term profits rather than long-term profits. And so the movement towards sustainable investing may be less about E, S, and G than it is about changing your time preference so that you don't sell a stock when it gives you a bad earnings announcement. You don't sell a stock unless it's a bad earnings announcement that's not associated with some good sustainable investment. Okay, so let me give an asset pricing interpretation of this. If you want to know what the profits are going to be for a fossil fuel company 50 years from today, you've got a tough problem because you've got to forecast not only how much the economy is going to grow, but you're going to have to forecast what's going to happen to fossil fuels. You're going to have to forecast what happens to their fossil reserves and all this sort of thing. There is a risk that these fossil fuel companies face. And in finance, we know that if you bear this risk, you should get a risk premium. So if you invest in fossil fuel companies, you are likely to get a risk premium, which means you get rewarded for enduring this risk. Okay? It's not what you expected me to say, is it? But you would expect a risk premium for being exposed to this risk. So that's a positive return. If you don't want to bear this risk, and this is the divestment argument here, you would sell this company or you would short it. And if you short this fossil fuel company, you would expect to get a negative risk premium. That is a little underperformance, but that's your reward for not bearing this risk. Okay, so finance turns a lot of things on their head, and I just want you to think about that, because we're going to see that in the data. We're going to see that if you want to hedge this climate risk, which is what we were talking about, you're going to pay a little bit for that. You're going to pay a risk premium for this. And so we expect to see that portfolios which hedge your climate risk should, on average, expect to have a negative risk premium. Just like an insurance, when you buy insurance, you pay for it and hope it's not too expensive. Okay, so let me turn to some sort of concrete empirical questions, like how do these things really perform? You've probably seen that there are hundreds and hundreds of portfolios out there that are being advertised as green portfolios in one way or another, or sustainable in one way or another. And what we have in the Volatility Institute website is an analysis of how these things are performing. So let's take a look. So these are publicly available portfolios, and you could all buy these things. And I want to talk about how you evaluate them. So we've got things which are green ETFs. These are exchange-traded funds, such as wind, solar, and nuclear. There are also low-carbon funds. There are also mutual funds, which have been selected by Morningstar to have characteristics which are what we think of as environmentally friendly. That is, they might have low exposure to fossil reserves. They might have a carbon footprint, which is less than half of the S&P 500. They might have a high ranking on the E measure of ESG score. And these are all things that are talked about all the time in investment literature. And if you have an investment advisor and you've expressed interest in sustainable investing, you've heard all this stuff. Or maybe international funds that are sustainable. So how do these things do? Well, on VLab, which is the volatility laboratory that we run, we follow them every day. And if you Google VLab NYU, you'll get to us. Or if you can remember the website, it's vlab.stern.nyu.edu, it will get you there. And you see something like this when you Google it. And if you go to the next page, we've got volatility, correlation, systemic risk, long-run value at risk, liquidity analysis, fixed income analysis, and climate risk analysis. And that's the one you want. You go down to climate risk analysis, you click on that, and you'll come up with a page that I'll tell you what it is in just a second. But before I show you the page, what do we expect it to look like? Well, if you think that sustainable and environmentally sound investments are pretty popular, then that means they're actually going to be pretty expensive. These stocks will be expensive compared to what their returns are likely to be. So it's sort of paradoxical, but when stocks are viewed as something that everybody wants to own this stock, it makes it expensive, and it doesn't really change the earnings so that the returns are low. So the good news is that we're going to see these funds underperform, and we should say, yes, that's because they're so popular. And of course, if they're popular, that means that the cost of capital for these firms is low, and that means it's going to stimulate them to grow, and that's a good thing, but we are expecting them to underperform as a result. Okay, so other things being equal, we expect returns to be low, but if the climate surprises the market and is worse than expected, then these portfolios should outperform. So the question of whether they underperform or outperform depends on whether there's bad news about the climate over this time period or not. And if there is, then they should actually do pretty well. That's what we hope. And since we think we want a long-term benefit, we should be looking at long-term benefits, not just short-term. So here's what this page looks like if you go to it. We've got 4 benchmarks up here, which are the S&P, the EFA, a long-short portfolio, which is long the S&P and short the energy sector, or a stranded asset portfolio that Bob Litterman has constructed, which is particularly short the coal industry. And here we have returns, volatility, and Sharpe ratio. Down below, we have actually the performance of something like 100 of these funds that you could buy, and you'll find them in the newspaper or your stockbroker will have it. And so we've got not only return, volatility, and Sharpe ratio, but we also have the Fama-French 3-factor alpha. So if you regress them on the market, on the small minus big and high minus low, so growth and value and size, the alpha measures whether this fund outperforms compared with its risk or underperforms compared with its risk. So you can sort these portfolios, and I've now sorted them by alpha. This is a 5-year return. You can look at other returns, but you can see that this first one here, Van Eck Vectors Environmental Services ETF, has a positive alpha of 3.8%. So that means it makes 3.8% above what you would expect given the risk that it's taking in those 3 categories. It has a positive Sharpe ratio, return 14% a year, volatility 19% a year, and so forth. Second highest is 3.5, third highest is 1.9, and the fourth highest is actually slightly negative. So out of these 100 funds, we've got 3 that have positive alphas, and something like 97 that have negative alphas. So it's pretty clear that on average, they don't outperform the benchmark. So if you go to the next slide, this is our outperforming fund. Here you see its performance in red and the S&P in blue. And what you see is it does actually end up slightly ahead of the S&P here if you start at equal 5 years ago. But it looks a lot like the S&P. If you look at a long-short portfolio, which is long the S&P, long this portfolio and short the S&P, you see relatively it went down, then it went up, and then it went up, and it ends up at 104. So it's 4% up. Yeah.
Those numbers before or after the fees?
These, I believe, include fees. And the bottom is the volatility of this long-short portfolio, which you could, in a sense, think of maybe as a measure of the climate risk. Maybe more interesting is what's in this portfolio. So if you look down here, you see this is actually a wastewater portfolio. It's not what you think of as the environmentally friendly portfolio, but it, of course, is when you think about it. It just isn't what you expected. If you look at another one, which is the MSCI Spider All Country World Index Low Carbon. So this is a low carbon fund, and these have a lot of familiar names in them: Microsoft, Apple, Amazon, Facebook, Alphabet, Johnson & Johnson, Alphabet, the other stock, JP Morgan, Visa, and Nestle. So this is our green, low carbon portfolio. But what is it? I mean, it's a tech and finance portfolio. And maybe that is what we mean by an environmentally friendly portfolio, but it isn't what comes to mind when you say that. So there are a lot of problems when you think of sorting them by these ESG measures, which is kind of what most of these things are doing. And we do have to think about what is it we're expecting this portfolio to look like, and what performance do we expect for it. If you look over the last year, however, you get a little better picture. You can't read these, but it turns out that now you've got about 25 positive alphas. So over the last year, these environmental portfolios look a little better. Why is that? Well, first of all, maybe we've seen some evidence that the climate's getting worse. We've had some bad climate news over this year, hurricanes, wildfires, and stuff like that. It's partly because the market itself has been impacted by geopolitical risks, such as the trade war. And interestingly, the top performing asset is an exchange-traded note based on carbon futures traded primarily in the European Union, but also in California and New England. So this first one has an annual return of 91%, volatility of 83%, and an alpha of 53. Now, this is just 1 year, so I mean, you really can't generalize from this, but it's kind of interesting that the carbon price, thank you, is what's actually moving the most here. And here's sort of a summary. This is the alternative energy box. It comes up with average alpha, which is positive. But when you look at 3 years, 5 years, equal exponentially weighted or max, they're all negative. When you look at this whole big matrix, on average, we're talking about negative alphas. So what's the bottom line? The cost of investing in sustainable funds appears to be sort of high. It may be that they cost you something like 5% a year to be in. And unlike insurance, there's no guarantee that they'll pay off if the climate is bad. That's what we're expecting, but it's not really guaranteed. It's only a hope because you've used ESG numbers or something like that. So I'm going to show you in the next 5 minutes how we think we can remedy this problem. And this is in a paper called Hedging Climate Change News, which is coming out in the Review of Financial Studies, which I did with a bunch of other really smart people. And the idea is that instead of trying to figure out what's going to happen in 50 years, let's form a dynamic portfolio which has the property that when there's bad news about the climate, some stocks go up and some go down. We want to hold the stocks that are going up, and we want to short the stocks that are going down. So In order to do that, we need to figure out how do we measure bad news about the climate, and how do we do the econometrics to figure out what this portfolio would really look like. If you do that and you hold this portfolio dynamically over time, you can expect you will ultimately have a portfolio of winners for bad climate and be short stocks that are going to be losers in a bad climate. So we do textual analysis of the Wall Street Journal stories over 20 years. We measure the similarity of the word counts and phrases to a collection of climate change dictionaries. And so when the Wall Street Journal runs an article which talks about climate change, there's some words that appear in that article much more frequently than an ordinary article, and that tells us that there is climate news. And it's our inference that climate news is typically bad news, so we say, aha, there must be news about climate change. And we want to quickly look at the stock market and see which things were going up and which ones were going down in that period. Okay, we have a second measure as well, but this is enough to think about it. So these are the words that we find are most important from our climate change dictionary. And so when these things appear in the Wall Street Journal, we say, this is time to pay attention. What are investors doing? What are money managers doing? Here's a picture of this index, and it goes up when there are news about things that are natural for climate change. And so how do we find portfolios that correlate with this measure? And the answer is we're going to use portfolios that are weighted by characteristics of the individual stock. And for example, we might use this E-score, and we would form a portfolio of stocks weighted by their E-score, and then see if that portfolio correlates with our climate measure. And we could do that for different parts of the E-score. We could do it for different vendors' E-scores. We can do it for carbon footprint. We can do it for a lot of things and see which portfolio seems most correlated with the climate change index. We get correlations of about 0.4 when using the Sustainalytics E-score, and that turns out to be about as good as we can do. But we do think that there's some other methods that can be used. And so the implication of this is that the portfolio using Sustainalytics E-score does seem to move up when there is news that the climate is getting worse. And that might give us a little more confidence that this portfolio is doing what we want it to, and that it will really respond to climate change going forward, especially if the E-scores are kept up to date and so forth. By the way, Sustainalytics does this. Okay, well, this is not totally satisfactory, and so I'm just going to tell you a couple things we're doing now. We're trying to use things which, if I wanted to call them, I could call them machine learning, but I could also call them traditional finance approaches, to see which stocks seem to be individually correlated with this kind of climate measure. And so if you wanted to measure the correlation of a portfolio, you'd look at the portfolio. But if you could just look at an individual stock one at a time and see whether it's correlated with this climate measure. And so, but we want a correlation which is not constant over time. It might be changing over time because the business models are changing. So we use dynamic conditional correlation, which is one of the things that we do to get correlations that are allowed to change over time. And we do this for all the stocks in the S&P 500. And then we look at each point in time which are the 20% highest correlated and which are the 20% lowest correlated, and we do a long-short portfolio between those two. So this is kind of analogous to what Fama and French do, but it does it with a dynamic correlation estimator. We also do it with 50-week rolling betas and 100-week rolling betas. And if you construct these portfolios and put them into the table, which we don't have systematically yet, but we have it for a sample, you'll see that we actually, in this 5-year period when there were only 3 positive alphas, this portfolio, the DCC portfolio, does have a positive alpha. If you look at its performance over the last 5 years, one of the intriguing things is because this is a long-short portfolio, it doesn't really show the market downturns the way the other portfolios do. But it doesn't outperform the market because it doesn't have any beta sensitivity, and the beta is actually responsible for a lot of the stock market growth we've had. So you might actually treat this as an add-on to your other portfolio. If you look at the 50-week and the 100-week rolling betas and put them in here, you know, they're not too impressive. Those have negative but sort of reasonable alphas. If you look at the 1-year VLAB, then the DCC now has a negative alpha, not significant. It's not super convincing, but it's suggestive. We've got some better things we're going to do, which are more in the machine learning kind of direction. And it's kind of a well-defined problem, except that it's got too many parameters in it. You've got to figure out what weight to put on all these stocks in a dynamic setting so that you can match this one index. And that is a good problem for machine learning. Okay, so in conclusion, what do we think ought to be done? Well, first priority would be to get a price on carbon. If you can't get a price on carbon, you probably need to do some more regulation. But you need somehow to get businesses, the private sector, working on carbon efficiency rather than just energy efficiency. It might be advocacy, transparency, legal and political actions can make carbon efficiency work, even if you can't put a price on it, but it's going to be much harder. A lot of the cost of adaptation will be borne by local, regional, or federal governments, and these liabilities might force political action. Maybe, but local governments are being very slow to do the things that are needed. They need to build seawalls, they need to strengthen bridges, they need to get dams ready for higher flood levels, and all sorts of things. We're not seeing much of that. So these are my grandsons, and we wonder what is in their future. And I think if you've talked to young people, they're pretty worried about this. A lot of young people think that we're throwing away this planet, and it's their planet. They're going to live in it, and unfortunately, I hear a lot of kids saying, you know, the system is so rigged, I'm not even going to vote. I don't think I'm going to have children because I don't want to bring them into this world. These are actually such counterproductive responses. It's too bad to hear them. But it does suggest that we have a big obligation to do something constructive to help this problem. And if we could tell my grandsons that the problem is solved, they'd be a lot happier. Thank you. And there are microphones going around, so I hope you'll... I see one back there.
Thank you so much for your patience and for the lecture. So I have a question around the very warm off of the press report this week from the IMF. They did a report on the estimated loss of GDP per capita under two scenarios mainly, a scenario as business as usual scenario and 2 degrees aligned scenario, country by country. Now, all these things are not perfect, as you mentioned. The models are not perfect, but it was interesting to see that in all of them, in all of the business as usual scenarios, there were no winners.
No winners.
No winners. Every country lost percentages. So I'm talking about I'm talking about 6%. In the case of Canada, it was 6 point from the GDP permanently, which is very substantial. So it kind of begs the question of whether there's any way we can hedge this in a nice way without I don't know, going long on HVACs and going short on agriculture or something like that. So I want to have your idea on that, and linked to that is the idea of an economic collapse because of all this type of loss in ecosystems.
Yeah, so I think that's a bottom-up study, if I recall, and so when you start by defining the damages of each sector and then you add them up, I mean it's a very different approach, and it tends to give different answers. It actually tends to give lower answers usually, but I don't remember exactly what was in the IMF, but from what you said, it sounds like the answers are high. I don't think anybody would say that the hedge should eliminate the risk. It's only going to smooth the risk. And so that's the most I think we would hope for. I mean, we can't set up a hedge that would completely eliminate this risk. I don't think. So you also asked whether total economic collapse was possible, and I think it's probably not what we would expect. I mean, we can think about the scenarios where there's no life is finished on this planet, but probably that's really not what we're talking about. There are these tipping points that people are concerned about, and that would be the things that you would talk about if you thought that there was the total collapse of the economy. I mean, I think what's really going to happen is that there would be big needs in building new infrastructure, in building new, solar fields and wind fields and maybe geothermal. I mean, all these kinds of ways of getting energy, all of which are basically would require a lot of capital investment. So there would basically the economy would have a lot of investment. At the same time, there would be a lot of companies which would probably be closing or at least changing their line of business. I mean, I think you're not going to need as many oil refineries once this transition has happened. So I don't think it looks like the economy fails. It's just that it might be consumer goods get to be more expensive because you're spending such a large proportion of investment and labor on climate adaptation as well as climate mitigation. So I mean, I think it could be a very stimulating time. And, if we could all agree to do this, I think it would be a very productive period for the world.
The collapse was in the case we don't do this. So
The collapse is what?
was in the scenario where we don't do this. And
Yeah, oh, I see.
the right investments and
Yes, so if we don't do this and the temperature really gets high, you know, what's going to happen then? Well, we're going to get a lot of migration of people and species and businesses. I mean, Canada's going to get overrun. I mean, what are all these American farmers going to do when they can't plant their crops? They're going to sneak over the border at night. You're going to have to build a wall too, and there'll be homesteading in Winnipeg. You know, I don't know. We can be fanciful about this, but how about another question? Yeah.
I have heard you briefly saying that investors tend to be focused on short-term profits. Now, I do wonder if you have any suggestion. It's difficult to change the mindset of investors, of course, but I do wonder if you have any suggestions from the academic research. What kind of financial products can we put there in the markets that change these mindsets?
I'm afraid that's a good question. I've asked some of my colleagues, you know, how do you arbitrage short-termism? And I don't think I know exactly what the answer to that would be. I think certainly what you would expect these sustainable funds to do would be to examine why performance is slow and see if it's associated with some, you know, high value investment project that it hasn't come online yet. And, you know, analysts can do that. Analysts do have both short-term predictions and long-term predictions, and maybe it's just a matter of using the longer-term predictions rather than short-term projections to evaluate your portfolio. But I sort of think there'd have to be a change of language and the way you did this analysis, because obviously we can all promise stuff in the long run, especially if its long run is far enough in the future, and so the analysts will have a much more difficult job figuring out which promises are realistic and which ones are not.
I'm wondering, Ken McKinnon, I'm an investor in private businesses in energy and transportation, renewable. Oh, sorry. Ken McKinnon. Is this working? Can you hear me?
Yeah.
I'm an investor in renewable energy companies, next generation transportation, and they're private businesses. And in observing your information, statistics, and analysis, you leave out the private sector. So it's just the public companies. And, you know, in a way, they're not an appropriate sample because, first of all, there's half the number of public companies today than there were 20 years ago. So we have a smaller sample size. The market's dominated by, you know, the tech stocks that you've mentioned. That they've been outperforming every other sector for a long period of time. And so, you know, a lot of the capital that's gone into renewable generation, it's gone into private projects. And I can attest to the fact that actually returns are very good if you've been not upstream, you know, early tech, clean tech investing, but more downstream, where there's a lot of business model innovation, where there's a lot of disruption. And so through this, there's a tremendous number of stranded assets. Look at Germany, E.ON and E.OFF, what happened there. And that'll continue to happen as capital gets, you know, is allocated away from carbon-based companies because the returns aren't there. And so if their customers go away on the demand side, then ultimately, you know, you just won't have the same number of companies producing. So the capital, I would say, would get allocated to where there's growth, and that's in decarbonization, electrification, digitization, you know, decentralized and distributed energy, which is also a mitigation for, you know, major climate events, having solar panels and not having to rely on the electric grid. So I'm just wondering how can you incorporate what's going on in private markets into your studies, and how can you use that to the benefit of endowments, to say, well, we should be thinking not so much about the stock market, but about investing in private equity firms and VC firms that are really driving the technology change that you're talking about. Because if you look at solar, why has solar been adopted so much? Originally, yes, it was feed-in tariffs and investment tax credits, but now the levelized cost of electricity, go to the desert, it's way cheaper than coal or natural gas.
Right.
So I think that in order to get that moving even more capital has to be allocated.
Mm-hmm.
And so, endowments and other firms have to, other large investors have to think about how to allocate more capital, and then how do you track that and build that into what you're doing. So I'd suggest that, if you could look at the private returns, you may get a more complete view, but you just can't trade those stocks. It's a different thing. So sorry, it's a long-winded question, but
no. Well, thank you for your observations and your question. Obviously, we're only seeing publicly traded firms, and all these funds are constructed like that. So private equity plays a major role in many investment portfolios. But it's very hard to measure the returns on private equity because there are a lot of the features of private equity that make it complicated. So there are some funds which basically invest. Well, I mean, you can buy private equity companies, or private equity can construct funds that the public can invest in. And really, there is this giant pool of capital that's what we're seeing on these slides. And I don't know where the capital is coming from that you're getting, but there's probably a lot more capital that would be out there if people did list their solar and wind projects. And so I don't know whether that's something that might come from the industry. It turns out an awful lot of the energy companies are also private. So, we aren't seeing the whole universe. And it's certainly true that, I don't know how to answer the question, what are the returns on a private firm? You say they're doing well, and I believe they're doing well. In fact, I think that solar probably, all these technologies are now very cost effective, and so I'm not surprised they're doing well, but it's not that easy to invest in them.
No, in fact, it's very difficult for most people.
Yeah.
Larger, pension funds and endowments can participate, but you have to do it through private funds. So, and there's a very large private secondary markets that exist just because people don't want to go public because of all the volatility and because of the difficulty and costs associated with it. And so that's why the number has dried up. So anyways, I'm just saying, I think that...
A lot of costs of being part of a public private equity fund, too.
Yeah.
Yeah.
But anyways.
Yeah.
We can
no,
continue.
okay. Well, thank you. It's a good question.
One more question?
It's a little bit related to what you don't observe in the stock market. Since the frequency of severe weather and flooding has been increasing, we see that insurances for insurance markets are actually calculating premium.
Right.
And so I was wondering how much we actually learn from the increases in the insurance premium in the markets. Sort of similar to what you're trying to do with stock market data.
Yeah, I mean, I think insurance companies have been beaten up by surprisingly large damages over the last few years, and are now changing their methods of calculating the expected cost of insurance, and they're withdrawing insurance from some sectors of the economy. Apparently, you can't get fire coverage in California anymore, or at least Northern California, or flood coverage in Florida, and just a lot of things like this. So, yes, it certainly would be an important additional source, and we actually are hoping to do that. I don't really know whether we're going to be able to come up with a better measure of damages from looking at insurance pricing, but you know, as soon as these physical events affect market prices of financial assets, something happens, and that's what you're talking about, and that leads all these smart people that run these companies to do something differently from what they've been doing, and that's what we're needing to have happen to make this transition. But it would be so much better, and you'd be so much better off if the price of carbon were charged. I mean, you'd be arriving in a caravan. I mean, anyway. So, good. Good. Thank you. I'm sorry?
I'm just doing a few concluding
Yes,
remarks.
right.
Okay, good evening. My name is Laurent Picard, and in my capacity as the area coordinator for finance, I have the privilege of giving these concluding remarks. So first of all, I want to thank all of you for coming in numbers tonight. I also would like to thank my finance colleagues, Guillaume Rousselet and Fahad Saleh, as well as the Dean's Office for organizing this wonderful event. So the tradition of the Laurent Picard lecture is to invite highly distinguished scholars and hear their views about important topics at the intersection of several areas of management. And I think this year we scored high on both dimensions. We are privileged to have a Nobel Prize winner who just talked about a topic that has now become one of the top priorities of society, and including in Montreal, where several sustainability initiatives have been launched over the last few years. So, addressing global warming is a daunting task. It essentially requires that we reverse the 20-fold increase in emissions the 20th century set in train, and we have to do this at twice the speed. Okay, so and some of us feel that so many propositions have been made that it's to address climate change that it's difficult to know what to do. And this is why Professor Engle's lecture is extremely useful, because it simply reminds us on a few key aspects of the solution. One, an appropriate pricing of the externality caused by pollution. Two, a pragmatic approach from both individuals and companies. And three, a focus on financial innovation to manage the risk associated with climate change. And I see no one better than Professor Engle to talk about volatility. So to conclude, on behalf of the audience and on behalf of McGill, I want to thank you again for this very insightful lecture. Thank you.